Hello. Yes, good afternoon, everybody. I hope you're having a good afternoon. Today's webinar, we're going to look at how to manage your risk in the forex market. So, there is one thing which I have to make clear before we start, that this is one of the most important things that any trader needs to understand. If you don't understand how to control your risk, if you can't control your risk, please do not attempt trading. It's the most important, the most valuable aspect of trading that everyone needs to understand. You have to understand how to manage your risk properly. So even with the best strategy, which will give you maybe 80 to 90% accuracy, you still need to know how to manage your risk properly. So managing risk does not only involve putting stop losses and then leaving them like that. No, you must know how to calculate your lot sizes properly. You must know when to get out of a trade. You must know when to get into a trade. So right now, I want us to start from this point where let's first of all look at how do you place your stop losses correctly. How are you supposed to place your stop losses so that at least you don't lose much, you don't find yourself being stopped out also necessarily. Okay, the first thing you do, normally for me, this is what I use. If I have to set a stop loss, not if I have to, I always has to have a stop loss. I always have a stop loss whenever I'm trading. My stop losses are always above the previous candle's highest high, or the previous days, the previous 4-hour candle highest highs, or the previous day's highest high candle or lowest low candle, or the previous week's highest high candle, or the previous week's lowest low candle. So that would mean, for example, if I'm looking at this chart now, the one where we are now, so if I'm looking at the chart where I am now, and assuming I want to buy it as it is, for some reasons I want to buy it, the strategy we put aside for now, for some reason I just want to buy this chart. So you don't just come and buy it here. First of all, ensure that you know where your stop loss is going to be at. Ensure that if you're buying it here, you know very well that your stop loss is going to be at this point. Then calculate the number of pips from the point of entry to the stop loss. Have that in mind. Know that by having a stop loss at this price 1.36106, you're going to lose actually 59 pips. So also know where your take profit is going to be at. So if you have it here, maybe your take profit is somewhere around this point. Know where you are entering. First of all, know the point of entry. You'll enter here. Know where your stop loss is going to be at, and know where your take profit is at, and then know the number of pips you are putting at risk. So this is the very first step. If you don't know where to place your stop loss, please do not enter that trade. So this is the first criteria I use. I normally use the highs and lows of candles, the previous candles, or highest time frames, highest high of the day, lowest low of the day, highest high of the week, lowest low of the week, or even highest high of the month or lowest low of the month. Those are the key places where I have my stop loss fixed at. So if for example I enter trade here, the safest place where I'll have my stop loss is at this point. If I sell it, the safest place I'll have my stop loss is at this price. Does that make sense? Yes. If you don't know how to locate maybe the highest high of a candle or the lowest low of a candle, then if you don't know how to locate, if you don't know how to locate the highest high of a candle or the lowest low of a candle, then this is what you're supposed to be looking at. Go to your chart, find this indicator, the zigzag indicator, and then load it on your screen. This is one other way of ensuring that you truly understand whatever you're doing. So look for these highs. This is like the highest high, this is the highest high, this is the highest high, this is the lowest low, this is the lowest low, and this lowest low. So if you buy it here, you should have your stop loss below the recent lowest low, which is this, or should be this. But this is not the recent lowest low because we are not seeing the other leg for it like this. We are not seeing something like it. If it had formed this V formation, then this could have been the correct place to have our stop loss below. The other place is this. We could have had our stop loss there, and if we sell it, if you sell it instead of buying, then our stop loss will be somewhere at this price, or our stop loss will be somewhere at this price. So that is one way to set your stop losses. This is one way. This is one way to set your stop losses. So ensure that, first of all, the first thing, don't just come up with numbers. Like, don't just say I'm going to risk 500 pips, 50 pips, whichever. Do not just say numbers without proper consultation. So consult your charts. The stop loss or the take profit you're having must be based on an event in the market. So an event could be like the low of a candle, the high of a candle, or even the behavior of an indicator. Like if you have, maybe you have, this is like the lowest low of this indicator, this could be the lowest low of this indicator, this is the highest of this indicator. So you have your stop losses around those areas, the areas where the indicator was showing proper reversal. Is that correct? Does this make sense, whatever I'm saying right now? All right. So whenever you have this, well, after you've known very well that your stop loss is supposed to be here or your stop loss is supposed to be here, then go somewhere, just have your notebook, then put down you are risking 50 pips. Risking 50 pips. Put down somewhere you are risking 50 pips. So we are saying 50 pips at risk. And then now you say, okay, what is the correct lot size? Again, also when it comes to calculating lot sizes, do not just come up with lot sizes on your own. Don't just guess the lot size and then you find yourself trading lot size which you don't understand where they're coming from. Lot size must be based on the number of pips you expect to lose, and also the number of pips you expect to lose, and also the amount of risk. I mean the percentage of the capital you expect to risk. So you'll say maybe from your account you're risking 5%, and then that 5% is actually 100 USD. So you'll say 5% of capital, which is equal to how much? To 100 USD. So these are some of the most useful information which you have to have, first of all, even before you calculate your lot size. Yes. So now we have this. This is the number of pips you're putting at risk, and then this is the percent of our capital which we expect to lose if the price hits 50 pips against us. So that would mean our stop loss is away by 50 pips, and that away by 50 pips is just 100 USD. So we are supposed to calculate our lot size in a way that if we risk anything, we are only going to risk 100 USD, and the stop loss must be at most 50 pips from our point of entry. So now look at what we're doing. First of all, we have gauged how much we expect to risk in terms of pips and also in terms of capital. Then we now use that to calculate the lot size. It's not the other way where somebody will come and say, I want to earn 100 USD, then they go back to how much they're risking into the account, from the account. It's not the other way. First of all, know how much are you risking, then use that information to calculate your lot size. Don't start from the point where you're finding how much do you expect to earn, then you use that to calculate your lot size. No, it's not the other way. It's the way that I'm saying it. First of all, know how much you expect to lose in terms of risk, then know how much you expect to lose in terms of your capital, then use those two information to calculate your lot size. Is that correct? So this is how I would calculate, this is how I calculate my lot sizes normally. So this is the formula. Use it, you're going to be safe. So say lot size is equal to 100. This is in USD, the amount we expect to risk, divide by, so we divide this by how much? We divide it by 50 pips multiplied, this is 50 pips, we multiply that by tick value. So tick value is different for every sample. There are different tick values. Some pairs the tick value is 50, some pairs the tick value is 10, some pairs the tick value is 2. So depending on the currency you're trading, you need to know the tick value for that currency. So like in my case here, GBP, the tick value is 10. So we'll divide 100, the amount we expect to risk, divide by 50 pips times tick value. So when you do that, you'll get the correct lot size. Like in my case, let's do it. Let me do the math real quick somewhere else so that I give you the response. So we have 100, sorry, we have 100 divided by 500. So that means the correct lot size in my case, so lots equal to 0.2. So now you have a very useful information now. You have a very useful information. You know very well that if you want to risk 50 pips and you want to lose only 100 USD from your account, then the correct losses should actually be 0.2. 0.2. Does this make sense? Does this make sense? Okay. So when you want to trade this now and you want to risk this amount of money, ensure that your lot size is actually 2. Come and enter it. Have your stop loss the way you've said, that it will be 50 pips by default, and not by default as you've seen it, as we've calculated. And then by reaching price moving from where the price is now up to the stop loss, you shall have risked only 100 USD. So it's never always the other way. It's never always the other way where somebody will come, they calculate how much they expect to earn, and then use that information to come up with the lot size. No, it's not the other way. If you do that, you'll lose. That's the easiest formula towards failure. It's always the easiest formula. If you want to get into wrong trades, make bad decisions, then ensure you're making decisions based on what you expect to be getting. So another thing, anyone who understands how to control their risk is almost always above 50% accurate, because there is no indicator out there which is 100% accurate. There is no indicator, there is none. And if you check properly, notice that there's none which is 90% accurate. And if you even go much further, you'll find that there is none which is above 80%. And if you dig deeper, that's if you now understand exactly what you're saying, you'll know that there is also none that works almost 70% and above accurate. Normally the indicators are 60% at the time. Sometimes you tend to make a lot of money because those are good days for that indicator. But if you back test properly in the past, you'll notice that even with the best indicator, there's no guarantee that if you enter here, this will go up 100%. No. But whatever is guaranteed is this, that whenever you enter trade here, there is exactly 50% chance that the price may go against you or the price may go your way. That's the only guarantee, that whenever you enter any trade, there is 50% chance we may go your way or the price may definitely go against you. So how do you control that? Now we know very well how we are controlling our risk. We know how to enter, we know how to control your risk. We know very well that if you enter trades, if you have to enter any trades, first of all calculate the risk side of it first of all, not the gain side of it. And we also know that even with the best indicator, what's guaranteed is the 50% chance that the price may go your way or the price may go against you. So what now adds you an advantage over other people is if you have a proper risk management. If your risk management stands out, If your risk management stands out, then that would mean you are good. Have a proper risk management, then look for a strategy later. Have a proper risk management and then look for a strategy later. Not the other way. Do not have a strategy then have a risk